Hey, everybody, and welcome to this week's Nasdaq Dorsey Wright podcast for the week ending September 9th, 2022. My name is Will Gibson, and I'm joined this week by Joseph Tuzzolo. We're going to be going over mainly some of the value growth battle that we've seen so far this year. It's been pretty volatile in a lot of ways and pretty top of mind to a lot of advisors and investors that we're talking to. Joseph put a great piece in our report earlier this week about it. So if you haven't seen that, check out the report that was put out Tuesday evening, but we're going to put some color around that today. Before we do so, I think just some kind of high level technical points that I wanted to make on the market before we get into that discussion, noting some breakages of trend line or really just kind of pivotal places. S&P 500 index kind of broke its bullish support line on the 20-point chart that was in place or were drawn from the June lows. And then the Nasdaq composite likewise is in a rather precarious position. I would say it's kind of around some key support around that 11.5 range, also resting up against its bullish support line. So your equity indices are in a rather pivotal position. And also kind of as we'll talk about today, they got a pretty heavy tilt towards growth, kind of both of those. So it's pretty timely, I think, to talk about some of the stylistic battle that we've seen going on. And then even for the ag, just sticking with kind of major representatives here, and I think this dovetails nicely. This printed a fourth consecutive sell signal yesterday, and it's really advancing to the June lows, which is around $99. If you're on YouTube, we'll throw this chart up. But after that quick rally, it's been a pretty big headwind for fixed income markets lately, and the broad representative here has certainly felt that. So without too much to do on Joseph, I'll kind of let you come on and kind of introduce what you were looking at on the report on Friday, some of the relationship that you're looking like between value and growth.
Yeah, so one thing I really like to look at is performance spreads between two assets. In this case, we looked at RPV, which is the Invesco 500, S&P 500 Pure Value Fund, versus RPG, which is the Invesco S&P 500 Pure Growth Fund. And just one thing I like to look at is just a rolling 6-month performance spread. So if that spread's positive, in this case, RPG would have outperformed RPV over the prior 6-month period. If it was negative, then RPV would have outperformed RPG. Now, looking at this, you can get to see some historical extremes. Recently, in May of this year, we actually had RPV outperform RPG by about 34% over the prior 6-month period, which was the 5th largest spread in favor of value since going back to the mid-90s. So a pretty extreme move. After that, we did see that big growth rally. So I like to use spreads as almost a mean reversion sort of indicator. Whereas it's almost a checks and balances on momentum types of strategies, let you know that you may be swimming upstream past a certain point. Now, one significant thing over the past 2 years or so, essentially since this COVID sell-off in March of 2020, we've seen that RPG-RPV relationship reach extremes multiple times. It's taken multiple round trips. So after that COVID sell-off, we saw growth outperform wildly over value. And then if we remember early 2021, led by a lot of financials, we saw value really pick up the pace over growth. And then throughout the rest of that year, up until about November of 2021, we saw growth really outperform. And we saw multiple swings to historical extremes in just a couple of years. Most recently, as I mentioned, in May, we had value really be the winner there and reach some historical extremes there as well. So we continue to see that relationship be extremely volatile in both directions. Although I would say right now, looking at our asset allocation tools, we would still give the edge to value on a longer term basis.
Yeah, I can see that too. And kind of looking at that spread that you're mentioning, this looks to be back more what we call normalized territory, right around that 0% level. And like you mentioned before, looking at some of the asset allocation tools to tell us, given that we're at more normalized territory now, we don't see value at an extreme or growth at a performance extreme. Where is the trend with us still? And you kind of mentioned kind of value still tilting that way. And then you also mentioned or alluded to, at least before the call, that interest rates have been a pretty big driver of this relationship. So maybe add some color on that, or some further color.
Yeah, so looking at that relationship, interest rates have been extremely volatile over the past pretty much essentially year. We have that ML move index well above its prior 5 or 6 year average, really only exceeding these types of levels in 2008 timeframe, as well as 2020 as well. So we're seeing interest rate volatility really pick up over the last several months. And that's had, at least I believe, an impact on the growth value relationship for the most part, which seems pretty obvious when you look at higher interest rates. It's going to be tougher for those growth companies to refinance their debt and so on, and affect valuations there on out. But when we overlay that graph, we'll insert it into the podcast video, looking at that RPG versus RPV spread. We overlaid the TNX, or the 10-year yield performance, rolling 6-month performance. So just looking at the 6-month performance for the 10-year yield. And we found that, when the 10-year yield is going up, value is going to outperform growth. When 10-year yield is pulling back or stabilizing a bit, typically the edge is going to be to growth in those instances. And we've seen that really be extreme, just like the RPG-RPV spread over the last couple of years, as interest rates have continued to be extremely volatile. The ML move index is still at relatively high levels, so I wouldn't expect growth or value to really take a significant lead or a comfortable lead from a relative strength perspective, where you're not going to get these large laggard rallies that we've seen from growth. We look back from that June to early August period where growth was on fire, it was on a tear. And during that time, rates pulled back from about 3.4% on the 10-year to less than 3%. And now we're back well above 3% over the last couple of weeks. And we've seen the impact that's had on equity markets over the last 2 or 3 weeks. We have the Fed dealing with interest rates and raising interest rates to fight inflation. Again, there's no real precedent we have in the modern Fed framework, at least going back to, you could look at the 70s, but even that case is a little bit different than what we're dealing with right now. The market seems to be extremely uncertain with regards to where interest rates are heading, given that ML move index level right now. And I don't necessarily see any clarity coming from the Fed anytime soon. This inflationary environment is extremely uncertain, especially when you factor in geopolitical risk like Russia, Ukraine, you have energy, you have droughts around the world still that we're dealing with, which we don't really know how that's going to affect either food as well as energy costs as well. So as long as inflation expectations and rate expectations from the Fed remain extremely uncertain, I would expect rate volatility to stay relatively high. And that would also mean that when we look at least the growth and value relationship, I would expect that to continue to be volatile, continuing through 2022 and entering 2023.
Yeah, and I think for all those reasons you mentioned, all the better to watch technicals, watch the charts, kind of watch what's actually happening, because I think it can be pretty easy to get lost in a lot of the headlines or get lost in what people are expecting to happen versus what's actually going on. So I think that's a good point you make there, especially looking at things like this to tell us kind of where we are in a market environment. So something else too that I think we were talking about, our teams talked about recently before, is that a lot of these major benchmarks are pretty growth heavy. So sectors like tech, discretionary are pretty big overweights in a lot of areas, and just the equity markets as a whole. So with the uncertainty, I think it also creates a pretty decent opportunity for alpha going into certain sectors that maybe are not as highly volatile or as sensitive to some of these dynamics to maybe go and outperform.
Yeah, and when we look at the interest rate issue, it seems to be a much bigger headwind for growth, right? And you mentioned that the indexes we're looking at, you talk about the Nasdaq 100, that's a very tech-heavy index. You look at the S&P 500, roughly 20% of that index is in, Google, Amazon, Microsoft, Apple, Tesla. So all these, growth-oriented type of companies, which operate as a big headwind there. I did mention in the piece, going for more a blend approach and portion of your portfolios can definitely help mitigate the volatility. Like we said earlier, I still think value is favorable from a relative strength perspective. Right now, areas like utilities and consumer staples can be somewhat safe havens in a rising interest rate type of environment. They typically handle it a bit better, at least when it's Fed-induced raising of rates. When it comes to utilities case, I know traditionally higher rates aren't necessarily good for utilities, but we did do a study when the Fed was raising interest rates, which sectors typically did well, and utilities was at the top of the list, believe it or not. So just because growth-oriented areas with higher interest rates necessarily won't do well doesn't mean there are sectors that can't weather the storm, as we just mentioned.
Yeah, utilities has been a pretty big standout. It's one of the few groups that is above the 4.0 threshold on our group scores page. So just given a technical score to every investable group, pretty much above the 4.0 is that optimal territory. So few groups are stronger than utility sectors specifically. And then you mentioned staples. I did a study as well in a report recently looking at post 70s, 80s environment, another hyperinflationary comparison. Of course, there's a lot of differences fundamentally and structurally between the market between now and then as it relates to monetary policy, especially. But point being is that you saw staples do actually quite well coming out late 70s, early 80s, and offered an opportunity to get away from your benchmark. So it's a tricky environment. Nonetheless, it's pretty noisy. You've seen a lot of this chop back and forth. Even on the group scores page, though, and this is a bit of a different topic we won't get into, but that S&P 500 funds group is still above the 90th percentile right now, which is surprising to see in a lot of respects. It's not all cap weighted funds; you have equal weighted funds in there as well, but pretty surprising to see the dominance from that. But despite such, like you said, some opportunities to go out and achieve some alpha. So I think that makes a lot of sense.
Yeah, and I think part of the difference that we're seeing compared to the last 40 years or so is we haven't had to deal with high inflation. We have rising interest rates and a poor equity market, which typically you'll see the bonds pick up strength if equities are doing poorly. At least over the last 40 years, that's that whole risk parity type of trade. We haven't seen that work out this year. That's a very different dynamic, especially for a lot of advisors out there, any portfolio managers that are, trying to mandate the 80-20, 60-40 type of split that we've traditionally seen over the last 30 or 40 years. That's not really working right now. So it definitely is going to take some more creativity looking at, on the bond side, you're probably going to be more focused on short duration and even getting into floating rates if that's accessible to you. So a much different environment on a lot of fronts than we faced over the last 40 years. Again, given that it's a very unique situation, I would expect the interest rate volatility to stay relatively high, which would, spill over into the equity market as well.
Yeah, for sure. And even on the equity market volatility, Joseph, you mentioned on our rundown call, or at least before such, looking at the VIX for equities, not necessarily to do technical analysis on the VIX in terms of breakouts and support and whatnot, but relatively speaking, it's still not as high as we've seen for a lot of this year. So there is some room there to go to the upside. Looks like it's kind of trying to break out, if you will, kind of put a technical term on it yesterday and today. So
yeah, I mean, the VIX has been kind of subdued during this move lower over the past 2 or 3 weeks, which is a bit interesting. That's not what we've seen for most of the year. It's actually lower than what it's been for the most part, which I think that's a bit bullish in the short term. On the equity market side, we don't see too many people panicking. Usually when the VIX is spiking like that, you're seeing people rush to the door for insurance. That doesn't seem to be the case over the last 2 or 3 weeks. So we could be getting to a place where some short-term bullishness comes into play. I know we've seen the market up about 1% today. We'll see if that can continue throughout the rest of the week. But, again, overall, I think that rate volatility story is going to be a big deal continuing through the end of this year and early next year as we see how the Fed deals with inflation. And they've said they're very data dependent. So we don't even, it's hard enough to predict asset prices. It's going to be even harder to predict those fundamental data points, right?
Yeah.
So a lot of uncertainty out there.
Yeah, for sure. Yeah. All the reason to stick to the charts I've heard said before. I mean, you can restate earnings, you can restate economic revisions, you can restate a ton of things, but you can't restate the charts. So that's a reason that we're kind of looking to them here to guide us. And if we can help you with that, or if our research platform can help you do that, you can always reach out to us, phone or email. We're very accessible. So Joseph, that's kind of all I had to cover today. Any parting shots, or I think we're good to land the plane?
No, that's it. I think we covered a lot of stuff today. Hopefully everyone is handling the market fairly well. I know it's been fairly volatile and tough for everyone, but that's all I got today.
Yeah. Same here. And we're with you. I mean, as John and Ian were talking about last week on the podcast, it's been a tough year for trend following and really any type of analysis, whether it be fundamental or technical. So we're with you on that, and we're kind of thinking through and working through ways to navigate. So all that said, thank you for your time this week. We sincerely appreciate it. And if we can be of any help, don't hesitate to reach out.